And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
Got muted. Hey, good morning. How are you? Here we go. Sorry about that. Technical difficulty on this Tuesday. Good morning. Welcome to the Real Investment Show. It is Tuesday. My mic is now not muted. Problem with being live. Anyway, so a couple of things here as we kind of get this. This is the last full week of trading before we get to the Thanksgiving holiday next week. Markets are closed on Thursday, half a day on Friday. So next week, very light trading week. In other words, most traders are going to be gone. So it'll be inmates running the asylum all week long. So this is the last really kind of full week here before we really start getting into holidays. Volume tends to lighten up over the course of the holidays. So again, traders are out, those type of things. So anyway. Just keep in mind volatility is going to pick up here a bit. Yesterday, markets were kind of just sideways, and it was interesting because we started out fairly weak yesterday morning and then rallied back. And again, this is something we've been talking about here for a while, is that there's a lot of buying impetus now. That whole selling pressure that we had in July, August, September has now really August, September, October, has now kind of waned and is reversed. And again, as is always the case, and we've talked about this so many times here, but this is an important lesson, is that when things feel the worst, right, that's generally about the time that they're going to reverse. And so it's just a good kind of reminder, when you feel terrible about something, be patient, let things turn around in your favor. So nice rally here yesterday, holding above the 100-day moving average. Futures are pointing up a little bit this morning. Yields a tad lower, but this can change pretty quick this morning because we have the CPI report out at 7:30. Now, as we talked about yesterday, Jerome Powell gave a speech last week, and he already has this data for CPI, or at least a big chunk of it. And, the comments he made, he said, in particular, he said that inflation is not where they want it to be. And that, this is kind of keeping that maintenance out there of this one more rate hike on the horizon. And that probably suggests that today's inflation report may be a little bit hotter than expected. So estimates right now are about a 0.2 increase and probably be 0.3 on CPI. So don't be surprised if CPI comes a little bit higher. The drivers for that are going to be used car prices and healthcare costs, healthcare insurance. Healthcare insurance rose over the last month or so. That picked up about a 1% growth, and that's not surprising because we're now getting into healthcare renewals for insurance companies. So like at your job, this is about the time the window opens for you to sign up for healthcare costs. So not surprising because of inflation, prices are up. That's going to feed into CPI. The second thing was the auto workers strike that limited the number of cars out. So your used car prices are going to probably rise here a bit as well. So that's going to kind of feed into some of that inflation print today. Most of that's mostly transitory. As the economy continues to slow down, those prices will come down. The big driver, though, is homeowners equivalent rent makes up more than a third of the index. That's going to be lower. So that's going to keep a constant suppression on inflation over the course of the next year or so as those home prices continue to feed through that economic data because of the lag. Also, oil prices have dropped over the course of the last couple of months. That's going to also lead into some disinflationary pressure on CPI index. So again, probably a inline to slightly hot reading this morning. That could certainly push yields a little bit higher today, so don't be surprised about that. Yields right now are pointing lower, but we could see that reverse once the CPI report comes out. If the inflation data is really too hot, if it comes in much hotter than expected, especially at the core, that could impact stocks today, kind of reverse that on expectations the Fed may have to hike more. But again, the Fed's been pretty clear, and Jerome Powell's been pretty clear that inflation is trending towards their target. That's their goal. They want to get back to 2%. And again, that latest speech kind of suggests that most likely we're going to see inflation kind of in line with expectations today, maybe slightly higher. We'll see how that comes out But again, that's going to be the big driver today. Tomorrow, of course, is PPI. We'll have that weighing on the market as well. Once we get through that, then things are going to kind of lighten up economic data-wise through the holidays. So again, just kind of keep that in mind. Here's what you need to know before the bell. Let's make a run through some of the markets this morning. As we said, if we take a look at the S&P, got above the 100-day moving average, tested it yesterday. Hopefully today, if we can hold above that, what would be great is if this market can rally today and get above Friday's high, that would actually be very bullish here, and that would clear that 100-day moving average resistance, turn that resistance into support, and that would open up the target for 4,500 on the S&P, which is our target for the year. So again, we're moving in the right direction. Markets are a little bit overbought here. So again, this kind of sloppy action, even though the market's been kind of grinding higher, it's been sloppy over the last few days. That's because this market's pretty overbought here. So again, the MACD buy signal still has room to move higher. So again, that's why our target's higher for the end of the year right now. But again, this little overbought condition, we could see a bit of a pullback today, tomorrow, Thursday, Friday, something like that before we get into the holidays. That would be normal. Normally see weakness, as we said yesterday before the Thanksgiving holiday. Coming out of the holiday, you tend to see stronger market performance as well. So again, but somewhere in here, because the market's overbought, we're going to get a little bit of a pullback. That'll be a buying opportunity if you want to add exposure to portfolios. On the small cap, mid cap side, if we look at the Russell 2000, that's a very different picture. Nothing good going on. So again, this remains a very bifurcated market overall. And again, we can tell that by looking at the equal weighted index. If we take a look at the equal weighted index versus the S&P, it's a very different picture. So outside of those 7 stocks, Apple, Microsoft, Google, Meta, et cetera, outside those 7 stocks, there's really not a lot going on in the market. The other 493 stocks are basically about flat for the year. You take a look at the equal weighted index, there's been basically no performance this year at all. Of course, that's been kind of the story all year long. On the outside of that, take a look at commodity prices. Oil prices, been under pressure here as of late, which suggests that economic data, the economic data is slowing down. And again, as we take a look at, consumer spending, definitely saw a drop in consumer spending in October. Oil prices reflecting a more kind of deceleration in economic activity and supply-demand imbalances. Starting to see that slow down here. That's going to feed into inflation ultimately as we get slower economic growth. But again, we are getting pretty oversold on oil prices, close to a buy signal. So we could see a move up in oil prices here as we get into December. Again, these little bouts of activity, certainly not surprising. But if you're looking for a trade in energy stocks, probably one coming up here fairly shortly. Outside of that, gold, of course, continues to really not do a whole lot this year. Big flat trading range most of the year, and coming back down to test resistance here, test support. Big cluster of moving averages, 50, 100, 200-day moving average, all sitting right here. So very, very good support for gold prices here at 1935-ish. Should hold there. If we break below this level, then we've got, definitely a retest of that 1800 level that we saw earlier this year. But again, on a sell signal here, so gold certainly has been under pressure as long as we're on that sell signal for right now. Taking a look at the dollar, of course, that's been the big driver economically, kind of globally. Dollar continues to be very strong here. Now, remember, back over here, in July, we were writing a lot of articles about de-dollarization and everybody's fear that the dollar was going to collapse. Very strong rally since, again, narratives, we talked about that. That dollar rally kind of stalling here a bit, but again, nothing really bad going on here. That's giving some support to both the markets as well as commodities, and that's why commodities kind of holding up here, even though we've seen some correction. That's what you need to know before the bell this morning. When we come back, we'll got a lot of stuff to get into this morning, but we'll talk about that Moody's downgrade yesterday as well. So don't go away. More of the Real Investment Show coming up right after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
So as I was saying, markets, here a little bit overbought short term. We've had a big move, very outsized for any given month of the market. So markets, Nasdaq's up about 7% from its lows in October. And, so there's certainly some things that suggest we could see a little bit of a pullback here before you get another advance into year end. Now, when that pullback occurs is difficult to tell. Particularly when you have a lot of momentum behind the markets, it's they can stay overbought longer than you expect, but ultimately you'll get a pullback for some reason or the other, and then you'll be some headline narrative, and then you'll get a push into the end of the year as you get portfolio rebalancing, window dressing. But there's a couple of things on the horizon right now that certainly potentially provide that catalyst for a bit of a pullback. CPI report today, if it comes in a lot hotter than expected, could certainly see the markets pull back here a bit. It was interesting, we talked about on Monday that, Moody's had come out, they had downgraded the U.S. debt to a negative watch. And, we've seen these things before. And as we said yesterday on the show, it's like, why anybody pays attention to them, I have no idea, because it means nothing. You didn't change the rating. You just said, well, if you don't clean up your room, Jimmy, you're not going to have your dinner. Well, you're still going to feed your kid dinner. Nobody wants to get reported at CPS. So, you make these idle threats, hoping that it'll have some effect, but in reality, you're not going to do much about it. And that was the case yesterday. And I thought it was interesting because the media made such a big hoopla about this, right? And again, this is why I always tell you to be very careful about, watching stuff on YouTube. There's a lot of people on YouTube out there that are kind of end of the world, doom and gloomers. Everything's bad. The world's going to die a horrible flaming death. And it's easy to get looped into that because it sounds very logical. But, as we talked about recently, talking about bell curves and statistical probabilities of events occurring, those tail events could certainly happen. They just don't normally happen, right? They're very rare events when they do. Depression, 1933 depression. That was one of those rare events, right? Financial crisis in 2008. That was one of those more rare events. It can happen. It just doesn't happen very often. So you can't kind of live in this world where everything is going to lead to the end of the end of the universe. And if it does, it's not going to matter anyway, right? So you always keep these things in focus. And of course, so, the latest negative, bear headline was, here's another, debt downgrade by Moody's, and this is going to be terrible. And markets kind of shrugged it off yesterday, right? Opened a little bit lower on it and then rallied back to close flat. Now, I thought it was interesting today because CNBC this morning has an article out kind of repealing some of their previous reporting. There was a time, this is a quote from CNBC, there was a time when bad news about U.S. debt would send markets into a tailspin, but not this time. Markets on Monday shrugged a warning Friday from Moody's Investor Service that was lowering its ratings outlook on treasuries. The big three rating agencies said high levels of government debt and deficits coupled with political brinkmanship in Washington could jeopardize the global standing of government-issued fixed income. When Standard & Poor's and Fitch issued similar warnings, they sent at least a temporary shockwave through Wall Street. And that was true, except here was the problem. So when S&P downgraded the U.S. debt, actually did a downgrade of U.S. debt. That was back during 2011 during the debt ceiling debate standoff. And this was at a point in time where the Obama administration cut a deal to potentially cut the debt, cut spending at least by $1 trillion. And it turned out to be a giant fiasco all the way around. But, nonetheless, there was a temporary agreement. And so the debt downgrade occurred and yields fell by almost 150 basis points very quickly after that. So it was interesting that, here we go again. And we have another rating agency put out this thing and everybody's freaking out. And nobody realizes that it doesn't matter. You could make treasuries single A rated. Nobody cares. Because if you're going to store your reserve currency, you have to store it somewhere. The only place you can store it with relative safety is U.S. Treasury. And it doesn't matter whether it's A rated or AAA rated, they're still going to store it in U.S. Treasuries. Because again, who are you going to trust? As we've talked about before. Here's a statement from Michael Reynolds, Vice President of Investment Strategy, Glenmead Investment Management. This is from the CNBC article. If we go from AAA to AA, what does that practically mean? It doesn't really mean anything. There's still plenty of demand for U.S. Treasuries en masse. There's no piercing insight from Moody's that they have proprietary information that nobody knows about the U.S. government, so it's a non-event. And that's a true statement. So again, narratives. We have another narrative coming up Friday. Government shutdown. So we have a new House Speaker. He's trying to do a end run here with some type of innovative strategy rather than just passing a budget and doing the 13 spending bills. We're going to try to do this two-part continuing resolution and trying to get that passed. He's not going to get it passed with Republicans, which means he's going to have to pull in Democrats to get it passed by Friday. And which means that he's going to have to cave at some point on funding for Ukraine and for Israel. We'll see what happens. But again, this is going to have to be a clean continuing resolution, no budget cuts whatsoever, because we have a broken Congress that cannot operate within the constitutionally defined processes that run our government, right? Which is having a budget. And for some reason, we can spend all of our time coming up with all these other things that we need to spend money on, but nobody can spend a couple of months coming up with a budget. So maybe instead of trying to come up with all these other spending programs that we want to spend money on and sending money here and sending money over there and doing these other things, maybe we need to spend a couple of months, just shut everything down in Washington and do a budget. I know that's pipe dream, but you have a job, right? You have a responsibility. This is your job as the House of Representatives. You are in charge of the budget. You control the purse strings. That is your job. But for some reason, we just can't do that. So here we are once again up on the verge of another government shutdown. And if we don't get this passed, we'll have a shutdown. My view, shut it down. Right? At least if the government is shut down, you will act to get something done. And the longer it's shut down, the more painful it is for the U.S. government. Not for us. I mean, everybody expects that, this is just going to be a terrible event for the U.S. economy. It's not. Social Security checks are still going to go out. Interest is still going to get made on the debt. Veterans are still going to get their, military still going to get paid. Now, parks are going to be shut down. Department of Education will be shut down. Not really much of a loss, considering that the ACT scores have now dropped for the last 5 years in a row and are look pretty dire. We're not educating our kids, so I'm not sure Department of Education is doing anything worthwhile. Maybe it's time for a change. But, different argument. But those are the things that are going to get shut down. And you know what? That's painful for the government. It's not painful for the U.S. For us. It's not going to change a thing for us if the government's shut down. Your Social Security check's still going to show up. It's mandatory spending. It's going to get paid. So, shut it down. As long as it takes to get back to a budget. But again, this is also going to come up to the fact that we've got an election coming up next year, and it's time for people to start voting for the representatives they want in office rather than just voting for whoever. We just had an election in Houston. 13% of the population voted. 13%. You barely cracked double digits of getting people out to vote. So don't complain about Sheila Jackson Lee becoming mayor. She's going to win in the runoff. It'll be Sheila Jackson Lee versus John Whitmer coming up in the runoff election. Sheila Jackson Lee is going to win. She's going to be the mayor. So don't complain about who's running Houston and the course of the city if you're part of the 87% that didn't show up to vote in the city election. You get the vote. You get the government you vote for, right? So these are, but if we don't start making a change, then these problems that we keep talking about in terms of debts and deficits and spending, et cetera, are only going to get worse because that's the easy path for politicians. It's easy to spend money, right? As long as you can keep printing currency and keep printing debt, it's easy to spend money. And nobody wants to cut spending because that means you take money away from projects or districts or whatever it is. And that doesn't get you voted, right? That doesn't get you votes for office. Oh, well, Mr. So-and-so took so much money out of my district, right? I lost big contracts, whatever, because they cut spending in my district. They closed a military base, whatever it is. So he gets voted out of office. It's easy to spend money. Being fiscally responsible is tough. And it's the job of every person in Congress, both Democrat and Republican, to be fiscally responsible. But we just don't want to do that. So, point is, though, is that we have all these conversations about debts and deficits and all these issues, but nobody really wants to do anything about it. Why? Because it's easy to spend money. But my point is that the debt ceiling narrative, the government shutdown narrative, it's going to crash the markets. It's not. We need a good government shutdown to maybe get some controls on spending in Washington. That would be helpful, but it's not going to be the event that crashes the market. So just, like I said, as we talked about all week, be careful of narratives. Be right back after the break.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that Candid Coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
You can get daily real investment news you can use, delivered at the speed of the internet. Sign up for Lance's newsletter now at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
The bets are on right now for the NVIDIA drinking game.
The Real Investment Show podcast.
Every time NVIDIA says the word AI, you have to take a shot.
Same show, your schedule.
By the time they get through the earnings call, half the country will be completely obliterated and it really won't matter what they say their earnings were, which will be just in time for the debates. Exactly.
At realinvestmentadvice.com.
That's a whole other drinking game right there.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Real Investment Show podcasts are now available on iTunes. Listen anyplace, anytime at iTunes.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell report. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So, talking a little bit about, when we were talking about inflation a little bit earlier, we talked about consumer spending has slowed down a little bit. And thought it was interesting. Home Depot reported earnings this morning, or yesterday, sorry, after the bell. Their sales declined 3% from a year ago period. They topped Wall Street estimates, of course, because they had lowered estimates so much for earnings, but still beat it. But importantly, the quarterly sales declined by 3% from the year ago period. It was interesting because the retailer indicated, I'm going to read to you from the report. The retailer indicated caution about the coming months as it narrowed its full year outlook. It said it now anticipates sales will fall by 3 to 4% from the prior year, compared to a previous expectation of a 2 to 5% decline. Home Depot expects per shares earnings to slide by 9 to 11% compared with the prior guidance of 7 to 13. So, what's interesting though is that this is kind of one of the bellwethers of consumer spending from a couple of different aspects. When things are really good in the economy, people tend to do a lot of their home maintenance stuff by hiring it out. I got excess capital. I'm doing okay right now. I'm going to go online to, Angie's List or whatever, and I'll hire this out to, build my porch or whatever I'm going to do, right? Repair stuff. When things start to get tight around the belt, people tend to do their own stuff, right? Start mowing your own yard. You start doing your own repairs, which you go to Home Depot for that, or Lowe's. and you're doing a lot of your home repair stuff. And again, when things get really tight, you start postponing those things, right? I need to repair that, but I don't have the money right now. I'll get around to it. And so Home Depot is a really good kind of economic indicator when you look at it from that aspect. And what they're telling you is that the economy is slowing down. And maybe, and we've talked about this before, is that there's been some reports out there from people that the economy is probably slowing down more than people expect. And we just haven't seen it reflect in the data yet. But, we're seeing it from the restart of the student loan payments, et cetera. That's starting to cut into spending. In fact, there was a report out that from the National Retail Federation. I'll just read. The consumer took a spending break ahead of the holiday season, with October retail sales, excluding auto and gas, falling by 0.8%, 0.08%, and core retail, which also removes restaurants, declining by 0.03%. And this is according to the NRF Retail Monitor. Mind you that that October has one of the biggest shopping days of the year in it, Halloween. So we saw people, and we talked about this before, high candy prices, saw people buying less candy, that type of stuff. So we saw that kind of coming in the data, but it hasn't been reflected yet in the overall kind of economic trends. Economic aggregates still seem to be okay. Remember, we just printed 4.9% growth in Q3 of GDP. At least that was the initial estimate. So what's interesting is that we're seeing the impact potentially early of softer retail spending as savings run out, as higher costs weigh on consumers. Again, we've talked about here on the show before, the cost of eating out is just crazy. Interesting story out a couple of days ago. This guy is scanning his groceries at a grocery store and scans all of his stuff and puts it in his, self-scan. You do your self-checkout now because nobody wants to actually check you out anymore. So he did his checkout of his groceries, and he's walking out the door, and one of the retail associates at the grocery store says, "Hey, can I see your receipt?" He blows up, right? It's like, you want me to check out my groceries, you want me to do all your work, and then you want to check my receipt. And the guy's like, yeah, I kind of. And the guy walks out of the store, right? But what's interesting about that is that grocery stores build in a loss factor for groceries. They know people are going to steal, right? It's normally about 2%. Since they've installed self-checkout, it's gone to 4%. So inherently, most people are thieves. But it gets worse when your groceries are now $400 or $500 a month and you don't have money. It's very easy to kind of, not scan something, maybe not scan a more expensive item, or you buy an organic apple and you mark it out as a cheap apple, that type of thing. People will do that, right? It's inherent to human nature, particularly when money's tight. I got to have groceries, got to eat. So when you have a combination of high prices and you have this, kind of drag on incomes from higher interest rates, debt payments, those type of things, there's eventually going to be a collision between what you can afford and what you have to have, right? And, the things that you want versus the things that you need. And then all of a sudden, reality kind of sets in and spending slows. And we may be seeing the early stages of that. And look, we're about to get some really good data coming out over the course of the next really 3 months, because we'll have Thanksgiving reports, Black Friday sales, which started 3 months ago, and then Christmas, and then, of course, New Year's. And then once we get into January, February, and then Valentine's, right? So this is the best time of the year for my wife right now. Birthday's December the 1st, Christmas, New Year's, Valentine's Day. She gets it all at once. But I figured it out, though, Brent. Yeah. So she's very hard to buy for, right? So I now get her to just pick stuff out on Amazon, put it in the cart, and then I buy it. But it works. She always gets the present she wants. It's never a debate.
Well, think about it, too. You have the right of veto.
I do. I never veto I never exercise that right. for self-preservation reasons.
I understand.
You could push that big red button. Don't recommend it. If you want to sleep in bed, don't recommend it.
That's right.
So we're going to get a lot of good data coming out over the course of the next, couple of months about just how strong the consumer actually is and where we are in the status of those savings and those type of issues. And again, this is going to be important because this is going to tell us a couple of things. One, if spending is slowing down, you're going to have lower rates of inflation next year, which means yields go down. Let me repeat that. If you have slower spending, if you're expecting an economic slowdown, you're going to have lower rates of inflation and lower yields because they all work together. There's a lot of camp right now, though, in terms of the mainstream kind of analysts and economists. They're saying, we're going to have booming economic growth next year. We're going to have booming earnings growth next year. Earnings have now troughed, and we're going to have this massive expansion in earnings next year. Can't have that without stronger economic growth. And at the same time that they're expecting this expansion in earnings, they're expecting the Fed to cut rates. The Fed's not going to cut rates unless you have slower economic growth. So Wall Street economists talking mostly their book right now, not really putting a lot of research behind their analysis. So this will be important to pay attention to. Watch what these reports say here over the next couple of months because, again, when you take a look at companies like a Home Depot, take a look at Target's reports, Walmart's reports, talking about slower retail sales, slower foot traffic, those type of things. What we'll be looking for in particular coming out of the holidays are discounts on items to move inventory. How heavily are items having to be discounted to get them to move? We're going to get a lot of that data coming out after the Black Friday sales. So these are going to be things to pay attention to, but we're getting some early signs of this, that the economy is indeed slowing down. The question is how much? And what does that mean? Now, again, once we get into next year, we have a very big detachment right now between valuations and real interest rates. You cannot have real interest rates where they are currently and valuations where they are currently, right? We have fairly high valuations on a trailing basis. Normally, those should track fairly closely together over time. And right now, there's a big kind of gap between those two, which suggests two things. Either real interest rates have to fall, in other words, yields go down and inflation falls to support high valuations, or you have, which would only come if you have a recession, which also means that valuations will come down. In other words, they will rejoin themselves in the middle somewhere because valuations will have to fall along with interest rates and yields and inflation falling because you've now entered into a recession. That's how those will recouple. You can't have, in theory, a rapidly declining rate of inflation and interest rates to rejoin high valuations with having a strong economy, which is what you have to support high valuations. So again, a lot of these forward outlooks don't make a lot of sense. I have no idea how this is going to work out, nor does anybody else, by the way. So be careful of these forward-looking estimates about things that are going to occur because they're going to be revised drastically as we get into next year. But pay attention to the data. The data will tell us a lot here over the next month or so. All right, we'll come back, wrap up the show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
So coming up in late January, we're going to have a summit with Greg Valliere coming in to talk about the economic and economic landscape leading up into the 2024 election, kind of politics, economics, and financial markets, how they all blend together. We'll be having some data on our website in terms of registration, sign up, etc., coming here in the next month or so, as we get closer to putting that together. It'll be very interesting. But I bring that up because there's a new poll out this morning conducted by the Financial Times and the Michigan's Ross School of Business. And I'm going to read to you this clip, snippet from the Financial Times. It says, the new monthly poll conducted for the Financial Times and the University of Michigan's Ross School of Business will seek to track how economic sentiment affects a race for the White House. In 1980, as example, Republican Ronald Reagan famously asked voters whether they were better off 4 years earlier under Jimmy Carter, setting the stage for his landslide victory. And so, again, here we are heading into a presidential election race. It'll be highly contested, of course. And the question is going to be for voters, are you better off? Right? And the poll's kind of interesting because if you ask according to the poll, again, what I'm reading to you is just from the poll. I have no other data than just this poll. 35% of voters right now think that they are better off. And, that's not a lot. You've got a vast majority of your voting public saying that they are worse off now. But why are they worse off? Inflation, obviously, has been a persistent thorn as of late and continues to be a primary concern. 82% of the respondents cited rising prices as their biggest financial stressor that overshadowed other things in the economy. 82% pointed right. Why so you don't feel like you're better off right now. Why not? Inflation. So inflation is the problem. And again, inflation is not this uncontrollable thing, right? It's like, well, how did we get inflation? Well, you put $5 trillion you sent checks to household, $5 trillion worth to households, and you bailed out everything and you shut down the economy. So what do you think you're going to get from that, right? You're going to get inflation because you have too much demand, no supply. And now that's going to eventually work itself out, which is why inflation is going to fall. But that's going to take a long time. You've got to, as we talked about before, that pig in the python is going to take a long time. It's a very big pig in a very little python. It's going to take a long time for that to digest and work its way through the system. And we're getting there. It's just taking time. And so, this is going to be the key question coming up in this upcoming election is going to be, what are you going to do about inflation? And there's nothing you can do. Here's the problem. The only way that you truly cure inflation is to stop spending money in Washington. Right? Let the economy work itself out. And it's just got to do that over time. And it's not just, I just mentioned, right, we had $5 trillion worth of stimulus, but it's not just that. It was then another $1.7 billion a trillion in the Inflation Reduction Act. It was the CHIPS Act. It was this other act. And it's these continued these spending programs of government money, which is why our debt's increasing, that's keeping inflation elevated. Because we keep injecting more and more money into the economy, either directly or indirectly. And so at some point, you've got to say, I got to stop here. Let this stuff all digest itself out, and inflation will come down. But that's just the part we haven't gotten to yet. So only 25% of the people polled thought the economy was better. And that's despite the fact that you just saw a 4.9% economic increase in GDP. So see, that tells you a lot. See, sentiment and reality are two very different things. The data says everything's fine. Economy's booming, wages are up, people should be doing great, got a lot of excess savings. 82% of people are going, I'm not better off because of inflation. 70% of people are saying I'm not better off at all, regardless of whether it's inflation. I'm not any better off than I was 4 years ago. That tells you a lot about the economy, and it tells you a lot about what's really happening below the surface. So that's why I'm saying a lot of these economic headlines that you see, they look fine. Economic data is upticking. We're doing great. And again, as we talked about before, data doesn't just go in one direction, right? Even when you're heading into a recession, you're not just going to have a straight drop in the data. You're going to get these bounces along the way. And when we have a long string of declines, you're going to get a bounce in the data. And that's what we saw in the third quarter was, there's just a function to where I've cut spending, I've done without. As long as I can, I've got to go restock. And that's whether you're a household or whether you're a business owner. I can bleed down my inventories as a business owner as much as possible, but at some point I've got some relative demand coming in. I'm going to have to restock. And those restocking cycles create these bumps in economic activity, but the overall trend remains negative. And so this is why sometimes it's confusing between the economic data and what's happening really kind of on the ground. And again, 70% of the economy is driven by personal consumption expenditures. That's you and me going out, spending money, etc. How does this reconcile itself? Will depend on what happens next in the economy. Do we get another big spending bill that injects more capital into the economy? Or do you have a recession, right? If we don't get a spending bill of some sort and the Fed keeps rates elevated and keeps doing QT, you're going to have a recession in the economy. That's almost inevitable, which will reverse a lot of these issues. Now, the last thing that anybody wants, politician-wise, going into an election is a recession. If you're in office and you have a recession before elections, you are not going to be in office after the election. So don't be surprised if we get, and again, this is why you won't see any type of budget bills coming up to cut spending this close to an election. This is why you're going to have a continuing resolution that just continues spending until next year. And then you'll have another continuing resolution that kicks the can down after the election, because once you get to next year, nobody wants to deal with any type of cutting of spending going into an election. That's a surefire way to not get reelected. So don't expect anything to happen in government over the next 12 months. A year from now, once whoever is elected, then maybe in 2025, we can start talking about spending cuts, right? We'll see. But, it's going to, between now and then, don't expect anything like that. The big question is whether or not the economy can hold up between now and then. And if it doesn't, then the Fed's going to have to step in, start buying bonds, start lowering interest rates to help lift economic activity. And if you don't think for a moment that there isn't going to be pressure from politicians on the Fed, that's me, you're sadly mistaken. Because if this economy really starts to roll over before the election, there's going to be a tremendous amount of pressure on the Federal Reserve to cut rates because they want to get elected. So, interesting though, interesting poll. It'll be worth, kind of paying attention to this and seeing, and this is a new poll by the Financial Times. So it'll be interesting to watch this to see how well it tracks as we get into election cycles in the future. But, again, not surprising that the results of the poll were so negative given the rate of inflation that we have in the economy right now and the impact that it's having on the everyday household family. Nothing is more deterring for a politician than somebody that can't put food on their table for their family. And that's going to be the one thing that and that's how people vote. We've often talked about in the past that people vote by their wallet, right? If everything's fine, they'll vote for the guy that's in office, right? It's like, yeah, apparently he's doing a good job because everything's good. If everything's not good, they're going to vote for something different. They don't even care who it is. They'll just, it's not that guy. I'll vote for, there was I think a dog that was elected mayor in Colorado somewhere. That tells you how bad things get, right? At some point it's like, I'll vote for a dog. He'll do better than the other guy. So again, that's kind of what this is telling you, is that right now people are going to vote for anybody that's different at the moment. If things change next year and we have this boomer economic growth that a lot of economists are expecting, this kind of recovery in the cycle, then this could all change. So we'll see. All right, wraps up the show for the day. Of course, get by the website, realinvestmentadvice.com. Our latest blog is out talking about the difference between investing and speculation and 10 rules to follow, really 10 of the legends, Jeff Gundlach, Howard Marks, others, and their kind of rules that they use to manage money and things that you should think about. So it's a good little guide just to kind of keep on your desk. I publish it every couple of years because it's just a good reminder of how to invest successfully over the long term and not get so deterred by short-term kind of market movements that really don't matter in the long run. That's on the website now, realinvestmentadvice.com. Have a great day. See you back here tomorrow with Danny Ratliff for our Wednesday edition of The Real Investment Show. Like this video, please subscribe and click that little bell icon. We appreciate it, and we'll see you back here tomorrow.